We're jumping straight into MRA Holdings today. Everyone is watching the price action, but the real story is their massive strategic pivot from pure Bitcoin mining to AI infrastructure and their aggressive debt restructuring.
Exactly. You're tuned into the Easy Money Show, where we make sense of the market's biggest moves. I'm glad you're with us.
Subscribe and hit the like button because let's just set the stage for you here.
Let's do it.
It is April 2026, and MRA Holdings is sitting right at this massive, undeniably critical inflection point. I mean, if you were watching the market recently, you saw the stock jump 8% on incredibly heavy volume in a single trading day.
Yeah, a massive move.
Right, and they entirely outperformed direct peers, like Riot Platforms and CleanSpark. But here is the hook. The real reason we are bringing this to you today.
Valuation disconnect.
Exactly. If you look at the multiples, MRA Holdings is currently priced by the market like, well, a distressed legacy crypto miner. But under the hood, they are secretly sitting on the foundational asset base of a massive tech infrastructure platform.
And that disconnect between how the market is pricing them and the physical assets they actually own, that's where the entire opportunity lies for you.
Right.
So today, we are breaking down the specific mechanics behind this transition. We're going to look at a massive $1.1 billion debt payoff that completely shocked some analysts.
Yeah, that was wild.
And we're going to figure out whether this grand pivot to artificial intelligence compute is, a brilliant masterstroke by management, or if it's just a desperate gamble from a company trying to escape the boom and bust cycle of crypto.
So to truly understand the motivation behind this really aggressive pivot to AI, we first have to look at the immense value and, frankly, the terrifying volatility of their core mining operations.
Right, the legacy business.
Yeah. They have spent years building what we'll call an energy moat, and the raw numbers here are just staggering.
They really are.
If you look at the first 9 months of 2025, they posted a 59% revenue growth, hitting $704.8 million. I mean, explosive growth by any metric. But then you look at the fourth quarter of 2025, and revenue suddenly drops 6%. Oh, and they also recently reported a massive $1.7 billion net loss.
I'm really glad you brought up that specific figure because we need to demystify it immediately.
Wait, stop right there. Let me jump in. Because $1.7 billion is a terrifying number.
Oh, for sure.
If you're a retail investor holding this stock, your stomach just dropped. Are they literally burning through $1.5 billion in cash? Like, how does a company even survive a loss like that?
Well, they survive it because it isn't an operational cash burn.
Okay, thank goodness.
Yeah, the vast majority of that $422.2 million of it specifically was an unrealized paper log on their Bitcoin holdings.
So unrealized meaning they didn't actually sell the Bitcoin at a loss.
Right.
The market value of the asset just dipped on paper at the exact moment the accountants took their snapshot for the quarter?
That is exactly the reality of holding a highly volatile digital asset on your corporate balance sheet. When the price of Bitcoin fluctuates, accounting rules require you to mark down the value of those assets.
Got it. So it looks horrific on a headline.
It looks terrible. But the actual physical machine underneath is incredibly efficient. Let's talk about their energy cost, because this is their true superpower right now.
Yeah, let's get into that.
MRA Holdings is currently operating at an energy cost of just 4 cents per kilowatt hour.
Let me put that 4 cents into perspective for everyone listening, because in the fourth quarter of 2025, the industry average to produce a single Bitcoin skyrocketed to nearly $80,000.
Crazy.
So if Bitcoin is trading at $70,000, a huge portion of the mining industry is literally underwater.
Right, they're losing money on every coin.
They are paying more in electricity and hardware wear and tear than the digital gold they're pulling out of the blockchain is actually worth. But because MRA Holdings locked in that 4-cent power rate, they have this massive operational buffer.
And it actually goes beyond just cheap electricity. It's about how efficiently they convert that cheap power into computing force.
Right.
They own a 15% stake in a company called Irradian.
Okay.
And Irradian makes custom mining chips. So this isn't off-the-shelf hardware. When you combine those custom chips with their proprietary software, which they call MRA Pool, they're actually yielding a 10% outperformance compared to average network rewards.
I want to break down the how on that because a 10% edge in this industry is massive.
It's huge.
How does owning a piece of a chip manufacturer actually translate to outperforming the network?
Well, it really comes down to thermal dynamics and software routing.
Okay.
Irradian is designing custom silicon that is specifically optimized for the environmental conditions of MRA's facilities. They aren't just buying generic rigs and hoping for the best.
So they're custom fitting everything.
Exactly. They are using hardware tuned to their exact power flow and their exact cooling capacity. And then their memory pool software dynamically routes the computations, the hashing power, in the most efficient way possible across their entire network.
Wow.
So they are squeezing out way more hashes per watt of electricity than almost anyone else in the game.
I always like to think of Maro Holdings right now using a real estate analogy.
I love this analogy.
Imagine a savvy real estate developer who goes out and buys a massive, fully operational gold mine. Now, the gold coming out of the ground is nice, right?
Right, it pays the bills.
Exactly. It creates some hype, keeps the lights on. But the developer doesn't actually care about the gold.
Nope.
They bought the property because there's an industrial-scale electricity pipeline running directly to the land, and it's fully permitted and operational. The gold is just a distraction. The electricity is the real asset.
That analogy perfectly sets up what happened next, actually. Because all that efficient mining generates a massive treasury, but what they did with that treasury in March 2026 is what sparked that massive 8% stock rally.
The debt move.
Exactly. They executed a dramatic, almost violent restructuring of their balance sheet.
Walk us through the numbers on that.
So MRI Holdings sold off 15,133 of their own Bitcoin.
Wow.
Yeah, they essentially liquidated about $1.1 billion worth of their digital treasury, and they used it to repurchase $1 billion in convertible notes.
Okay, let's unpack convertible notes for a second because we throw that term around a lot in finance.
We do, yeah.
Why is paying off that specific type of debt such a massive win for the everyday shareholder?
Well, convertible notes are a toxic hurdle for a rallying stock. It's debt that, if the stock price goes up, the debt holders have the right to convert into fresh, new shares of the company.
Okay.
And that creates something called dilution overhang.
It's like trying to fill a swimming pool while someone keeps pushing the walls outward.
That is a perfect way to visualize it.
You can pump as much water or, in this case, value into the pool as you want, but the water level never actually rises because the pool keeps getting bigger. If you're a shareholder, your slice of the pie just keeps getting thinner.
You completely nailed the feeling of it. Every time the stock tries to run, institutional investors get scared that millions of new shares are going to suddenly flood the market and dilute their ownership.
So they sell.
Exactly. They sell, and the rally dies. But by taking $1.1 billion of their Bitcoin and buying back that debt at a discount, they permanently plugged the leak in that swimming pool.
They eliminated the dilution ceiling?
Yes. And plus, they saved $88.1 million in cash interest, and they dropped their total convertible debt load by 30%.
So they essentially stood up and told the market the dilution stops now.
Exactly.
So they've cleared out the debt and stopped the dilution. But, a clean balance sheet doesn't generate revenue on its own.
No, it doesn't.
They have to deploy that capital. Which brings us to the long-term bull thesis.
Yeah.
The AI pivot strategy.
This is the big one.
Yeah. They've entered a joint venture with Starwood Digital Ventures. The stated goal is to deploy 2.5 gigawatts of AI-ready capacity.
Right.
And management has publicly stated their target is to have 70% of their revenues coming from artificial intelligence by the end of 2026.
Which is incredibly ambitious.
70%. I mean,
Right.
That is a total transformation of the company's DNA.
It is, but it's a recognition of a harsh new reality. In the artificial intelligence boom, the single most scarce resource on the planet isn't, NVIDIA computer chips.
No.
No. It's the electricity required to run those chips.
Yeah.
MRA Holdings already have the power infrastructure fully permitted and energized.
Right.
They're just swapping out what the power is plugged into.
But let's get real here for a second, because pivoting 1.9 gigawatts of existing power from crypto mining to hyperscale AI data centers is not just a matter of flipping a switch.
Definitely not.
I've got to push back on the hype right now. You can't just unplug an Antminer and plug in an NVIDIA server rack.
Yep.
The physical realities of these two operations are entirely different. Are they trying to run before they can walk?
Your skepticism is entirely justified there, and it really forms the absolute core of the bear case for this stock.
Okay.
Because the physical chasm between a Bitcoin mine and an AI data center is just massive. A Bitcoin mine is, practically speaking, a rugged warehouse.
Yeah.
It's incredibly loud, it runs hot, and it uses massive industrial fans
Yeah.
to just blow ambient outside air over the mining rigs.
Right, and if a few rigs overheat and shut down for an hour, it's not the end of the world. You just lose a few fractions of a Bitcoin.
Exactly. But an AI data center, that is practically a clean room.
It's a completely different beast.
It is a surgical environment When you are running hyperscale AI training models, you are dealing with liquid cooling systems that have to be plumbed directly to the server racks.
Mm.
You need redundant fiber optic networking with absolute zero latency tolerance. And the power redundancy requirements are just astronomical.
Because if it goes down.
If an AI training run gets interrupted by a power blip, it doesn't just cost a few dollars. It ruins the entire computational run and costs millions.
Meaning they basically have to rip out the entire internal infrastructure of their current buildings.
Yes.
They have to reinforce the floors because AI server racks weigh thousands of pounds more than crypto rigs. They have to install completely new HVAC and electrical routing.
It's a massive job.
The capital expenditure to upgrade these facilities is going to be astronomical, and the timeline is notoriously slow. Which brings up the most terrifying gap in this entire 2.5 gigawatt master plan.
The ghost town problem.
Yes, the ghost town problem.
They haven't actually announced any specific hyperscale AI tenants yet.
Exactly. They have this massive joint venture with Starwood, but it is purely a build it and they will come scenario. It's like laying down thousands of miles of high-speed magnetic rail lines across the desert, spending billions of dollars before you've convinced a single train company to actually use your tracks.
Right.
The infrastructure might be incredible, but until a Microsoft, an Amazon, or a Google actually signs a lease, it's just empty metal sitting in a warehouse.
And, the market is giving them a slight benefit of the doubt right now simply because the global demand for AI power is so insatiable.
Tech giants are desperate.
They really are. But until the ink is actually dry on a contract with a major tech tenant, it's all speculative capital expenditure.
And while they are building this high-speed rail to nowhere, they are also dealing with serious internal disruptions.
Yeah, the layoffs.
Just recently, they announced a 15% workforce reduction. Now, if you are listening to this, your gut reaction as an investor is probably panic.
Understandably.
Management is out there spinning this, calling it strategic right-sizing for the AI pivot. But I want you to think about the reality of the situation here. How do you execute the biggest operational transition in your company's history while gutting 15% of your staff?
It's risky.
Is that actually efficiency, or is that a massive operational risk masquerading as cost savings?
Well, it is a massive tightrope walk. But you have to look at the specific skill sets required for this pivot.
Okay.
When you transition from crypto mining mechanics to enterprise AI infrastructure, you need an entirely different type of brainpower.
So it's not the same engineers?
Not at all.
Mm-hmm.
You don't necessarily need the technicians who are maintaining fans and swapping out crypto hardware anymore. You need enterprise network architects.
Right.
You need liquid cooling specialists and corporate sales teams who actually know how to negotiate with Silicon Valley hyperscalers.
So a labor shift makes sense on paper. But, losing 15% of your headcount overnight still creates a massive cultural shockwave inside the company.
Oh, absolutely.
There is a very real brain drain happening. If they stumble during this physical facility transition, the lack of personnel could severely delay their timeline to get these data centers energized.
And even if they execute the facility transition perfectly and they hire the right enterprise engineers, we still have to confront the persistent crypto tether.
Yes, the elephant in the room.
Despite all these grand AI ambitions, MRA Holdings is currently chained to the price of Bitcoin.
They absolutely are. It is the unavoidable macro risk for anyone looking at this company today. I mean, they love to boast about having $5.3 billion in total liquidity, which sounds like an incredibly safe, impenetrable fortress of capital.
Right.
But you have to remember, for you listening, that a massive portion of that liquidity relies entirely on their hoard of over 52,850 Bitcoin.
Which means they are essentially a leveraged proxy for the crypto market, whether management actually wants them to be or not.
If the broader macroeconomic environment shifts and Bitcoin drops below key psychological support levels, say, it crashes below $69,000, what happens to all that runaway they just cleared?
Well, the value of their treasury plummets instantly.
Exactly.
And because algorithmic trading bots and the broader market still largely view MIRA as a crypto stock, the share price will get dragged down with it.
Regardless of the AI progress.
Regardless of how beautifully the AI data center build-out is progressing, the correlation between their stock price and Bitcoin is still incredibly tight. They haven't broken that chain yet.
So let's synthesize this for the listener. We have these competing forces violently colliding right now.
Yeah.
A brilliant balance sheet repair and a massive energy moat are fighting against heavy execution risks, the ghost town problem, and this volatile Bitcoin correlation. With all that noise, what are the actual tangible triggers that investors need to look for over the next 30 to 90 days? What is the catalyst calendar?
Well, the first major milestone you need to circle is their Q1 2026 earnings, which are coming up in late April or early May.
Okay.
But here's the trick.
Yeah.
Do not just look at the top-line revenue number. Because of the workforce reductions and the facility retrofits, the top-line number might be really messy.
So what's the metric to watch?
The crucial metric you need to hunt for in that earnings report is the revenue mix.
You want to see the exact percentage breakdown between their legacy Bitcoin mining operations and their new AI and digital asset management segments.
Precisely. If that AI revenue slice is starting to grow faster than expected, it provides a proof of concept.
Right.
It validates the entire thesis that they can actually generate cash from this pivot.
But proof of concept is just the start, right?
Yeah.
The real catalyst, the event that could completely alter the gravitational pull of this company, is what we'll call the golden ticket.
The AI contract announcements.
Exactly. The tenant signings are everything.
Yet, if ARA Holdings announces that they have officially signed a major hyperscale tenant for their 2.5 gigawatt Starwood capacity, the entire narrative shifts overnight. Analysts believe that kind of announcement will cause the stock to completely re-rate.
Let's explain what a re-rate actually means in this context for you guys. Right now, the market assigns ARA the low valuation multiples typically given to highly volatile, unpredictable crypto miners.
Right.
But if they sign a long-term lease with a massive tech giant, the market stops treating them like a crypto casino.
Exactly. And starts valuing them at the incredibly high premium multiples assigned to stable, predictable data center infrastructure stocks. Because a signed contract guarantees predictable, high-margin, long-term cash flow, it proves they aren't just building a ghost town.
Yeah.
And looking at the broader institutional support right now, analysts are mapping upside targets moving into the $10 to $12 range based almost entirely on the potential of that re-rating event actually materializing.
Which brings up a really fascinating strategic question, maybe a bit of M&A speculation for you to chew on.
I love the M&A angle here.
Right. With this newly cleaned up balance sheet, their active treasury model, where they intelligently sell Bitcoin to fund operations, and this massive, incredibly rare 1.9 gigawatt energy capacity, is Amara Holdings actually trying to build a long-term AI empire?
Or are they just dressing themselves up to be acquired?
Exactly.
The logic for an acquisition is incredibly sound.
Yeah.
Think about the landscape right now. Traditional tech giants are absolutely desperate for power to run their large language models.
We need it yesterday.
But building a new 1.9 gigawatt power facility from scratch takes years of environmental studies, local permitting, and grid approvals. It is a bureaucratic nightmare.
So if you are a massive tech company with deep pockets, it might be significantly cheaper and infinitely faster to just buy MRO Holdings outright.
Just buy the whole thing.
You take over their energized assets, and you retrofit the buildings yourself using your own engineers. By paying down their debt and removing that dilution overhang, MRO Holdings made themselves a significantly cleaner, more attractive acquisition target.
It's the classic strategy of renovating the kitchen and putting a fresh coat of paint on the house right before you stick the for sale sign in the front yard.
Exactly.
Whether they actually intend to sell or not, management is creating maximum optionality for themselves.
Bringing this entire analysis home for you. When you strip away the market noise, you are looking at a company that is currently priced like a distressed asset, yet it holds the foundational physical infrastructure required to power the global AI boom.
It is a truly unique risk-to-reward skew.
Yeah.
You have the downside protection of their ultra-low-cost energy and that massive Bitcoin treasury acting as a floor, combined with the explosive upside potential of a data center multiple re-rating.
Right.
It presents a very compelling 6 to 12-month swing opportunity for investors who are willing to weather the near-term crypto volatility while waiting for the AI thesis to fully materialize.
Here's the lowdown. MAR Holdings is attempting one of the most ambitious operational pivots in the modern tech sector. They have the raw power, they have the capital, and they have cleared the runway by masterfully restructuring their debt.
But execution is absolutely everything.
Everything. And the clock is ticking to fill those empty data centers before the market loses patience.
The physical transition from securing the blockchain to powering neural networks is fraught with friction, but the foundational assets they possess are undeniable.
I want to leave you with a final, slightly provocative thought to ponder. We are watching one of the largest Bitcoin miners in the world actively decide to divert massive amounts of precious electricity away from the blockchain and toward artificial intelligence.
Just a massive shift.
If the entities tasked with securing the crypto network realize it is infinitely more profitable to power AI instead, what does that mean for the future security and the very existence of the broader crypto ecosystem?
It is a structural shift that could change the underlying physics of digital assets entirely.
Subscribe and hit the like button. We'll see you next time.